On this episode, I'm going to be talking about two of my favorite tricks I like to employ when registering or applying for a mortgage bond. Welcome to the Property Corner with myself, Rowan Alexander. So these two tips are going to help you have financial options going forward and also help you that should you want to action them and unlock some value in your properties, you can do it in the quickest way possible. So I'm going to be giving you two tips that I use when I apply for and register my mortgage bonds personally. And I think these are two tips that are very useful to use. They give you financial freedom, or not financial freedom, they give you choices in future. And you have options. And if you've been following my content, following my advice, you'll know that I value options down the line more than anything else. Changing your mind in property is an expensive process with high costs of disposal and costs of acquisition. So building options into your property decisions that you will have later down the field or at a later point in time, if you're able to build in those options by making smart choices up front, they could save you a lot of money going forward in future. So the first tip is around flexi reserves, flexi bonds, access bonds. Different banks call them different things, but it's essentially the same thing. What a flexi bond or access bond is the ability to withdraw amounts that you've paid over and above your contractual commitment. So if your mortgage installment is 10,000 Rand a month, you are obliged to repay the bank 10,000 Rand per month times 12 months, which equals to 120,000 Rand per year. Even if you don't have the ability to repay more than your contractual amount, especially in the early terms of your loan, I'm going to give you some advice or a hack as to how you can actually work around that to create a flexi and access facility from day one. The easiest way to do that is by actually extending your loan term initially. So if you've budgeted to pay 10,000 Rand a month on your mortgage installment and to lend R1 million as an example, the easiest way to create an access without paying more than your monthly installment that you've budgeted for is by extending the loan term. If you opt for a 30-year bond rather than a 20-year bond, you'll find that mortgage installment comes down from maybe 10,000 Rand to 9,000 Rand a month. Now, 9,000 Rand a month becomes the new minimum payment that you need to make. But we know that you have budgeted to make payments of 10,000 Rand a month. The difference between the new commitment of 9 and the budgeted amount of 10,000 Rand, that 1,000 Rand a month difference immediately creates an access facility. Because if you've paid 10,000 whereas your commitment was 9, that 1,000 becomes available again on an access facility. So irrespective of whether you have the ability to repay more than your minimum installment day one, the easiest way to actually create that is by extending the loan term. Doing that reduces your monthly commitment, your minimum monthly commitment. Because remember, if you opt to pay 1,000 Rand a month extra every single month for 20 years, your loan will still be repaid over 20 years. Because often people say to me, but Rowan, isn't it better just to pay off my bond quicker? Yes, I'm not saying that you shouldn't be doing that. What I'm saying is make sure that your loan agreement is for the maximum time period that the bank will offer you. Because by paying extra, you will bring that loan down quicker. But by doing so, you will also create access, money that you can access in the form of an access bond or a flexi reserve. So that's one of the easiest ways to do it, because in year 2, 3, 4, 5, you might start growing into a position where you are able to repay more than your monthly installment. And if your monthly installment is based off the minimum, the lowest figure possible, that creates a bigger scope for access or a flexi reserve. Again, in the same way, or in the same trend, if you do have deposits, always opt to apply for the maximum loan that the bank would give you up front. You may be sitting on a 20% deposit to offer. I'd always recommend, if you do qualify for a 100% bond, rather opt for the 100% bond and put that money as a deposit in afterwards. By doing so, you will be able to access those funds immediately again, because they are seen as a prepayment of your monthly installments. So if you take transfer of that property and your first bond installment goes off and you then put in the 20% money afterwards, you'll find that your monthly installment will reset to the lower amount. If it hasn't, you can simply call the bank and request that they readjust or recalculate that installment for you, and that it goes to the lower amount. So always go for maximum loan value and maximum loan term. For the two different reasons. The maximum loan value, even if you have deposit, will allow you to create a flexi up front the moment you've put that deposit in. And by going for the maximum loan term, you and enabling that is lower than your budgeted amount, you will create the ability to create an access facility up front. Okay, lots been said about access bonds, and I think I've covered it before too, but just a reminder about that. The second tip that you can employ is to register a future use value. Now, I'm going to take some time to explain this properly because I think this is something that's misunderstood. When we as an industry or people speak about mortgage bonds, we refer to the mortgage bond as a loan. Or sort of the mindset is that it's a type of loan, which is true. It's a type of loan that's backed by security offered by the property. But that's where we need to distinguish better now for you to be able to understand how to utilize the future use. So the first thing that you have is that you have a loan agreement between yourself and the bank. That loan agreement dictates how much money they're willing to lend you, at what rate they're going to lend it to you, how long you have to repay that. So that's the first element to it. It's the loan agreement. The second element to it is the security that's offered for if you don't make repayments, they have the ability to recover that money by selling your asset, which is the house. And these two elements, being the loan agreement and the security that's offered, would constitute to the mortgage bond in the way that we would typically understand it. The reason why I'm explaining the two different components individually is because we're only going to be looking at registering a higher security value, which will allow you to renegotiate your loan terms in future. So it's important to understand the difference between the two. I'm going to show you a practical example about how you can go about doing that when you purchase a property of 2 million Rand. That will be the example. Typically, if you buy a property of 2 million Rand and you apply for a 100% bond, you're going to be registering a bond for 2 million Rand. What I'm saying is you're still going to be lending 2 million Rand, but you register a bond for, say, 2.4 million Rand, which would be equivalent to 20% extra of over and above the money that you're going to be lending. And once I start showing you the numbers, I think these things will make sense. So let's look at the financial breakdown. If you were to buy a property of 2 million Rand and you were to register a bond of 2 million Rand, the bond costs, if we look on this side, the bond costs would equate to about 38,000 Rand. Okay, that is the cost of employing an attorney to act on the bank's behalf to formally register your property as security for the loan. That cost is 38 million Rand on a 2 million Rand bond. Now, what I'm saying is we register an additional future use value at, say, the equivalent of 20% of the purchase price. So my bond amount would go up to 2.4 million Rand, the security that I offer. And the new cost of that bond registration comes to nearly 43,000 Rand. Okay. So that's about a 5,000 Rand cost to register the additional 400,000 Rand as a future use. If you were to do that at a later point in time, we know that your initial cost would have been 38,000 Rand based on the 2 million Rand bond. And if you were to then add a second bond at a later point in time for 400,000 Rand, you'll see that that cost alone is 15,000 Rand. So you've saved 10,000 Rand by going through the process of registering the future use value up front if you have the intention of using it. Just remember that you won't have access to that future use value of 400,000 Rand upfront. Your property needs to offer enough security for them to give you that loan of 400,000 Rand, but you also need to be able to afford the repayment. So, say 5 years down the line, your property may have escalated in value, and you can now offer them, the property offers them security of 2.4 million Rand, and your affordability has increased from 2 million Rand up to 2.4 million Rand. It's a very straightforward process. You simply contact your bank and look at restructuring your loan agreement, and then you can borrow that extra 400,000 Rand from them, and it could be paid out in a couple of weeks. You won't have the costs of paying an attorney to go through the process of registering a second bond because the security note is already on your title deed. You've already offered them more security than what you originally did. There's enough security to back your new loan agreement. So I hope that makes sense. If we're not saying that you can actually lend more money or borrow more money than what the property is worth from day one, but you're actually just registering a future use, the ability to unlock the capital growth in future if you are able to afford it without having to go through the rigorous process of employing an attorney to act on the bank's behalf to register that interest or that security at the deeds office. So these two pieces of advice will give you a lot of flexibility in future. It will give you financial options. You'll be able to unlock certain value at a very low cost and with very little effort. And it's something that I'd always encourage you to do. So go after the maximum loan term, go for the maximum loan values that you can be getting, and register those future uses up front. None of these you have to use or you have to be forced to use. You can control how quickly you repay your loan by making additional payments. In that way, you create your own flexi reserves. And if you have those future uses, no one's going to force you to make use of them. But if you need them, you can easily apply for a new loan and have your loan restructured and reset without going through those additional costs. So I hope you found this episode helpful. We're going to be dealing with more of these things in future. So if you've liked what you've heard, if this is your first time visiting the channel, please subscribe to us on your favorite podcast platforms or right here on YouTube. And stay tuned to more of this sort of advice with myself, Rowan Alexander.